Happy New Year, everyone, and welcome back for a fresh deep dive
Yeah.
into something I know we all love to think about.
Um,
Canadian tax changes for 2025.
yes.
We've got a great global news article here, just packed with
The
info.
big one this year.
So let's break it down and see how all these updates might impact your financial landscape for the year.
You know, it can feel like a chore sometimes,
Mm-hmm.
keeping up with all these changes.
Oh, yeah, for sure.
But think of it this way. It's like getting a sneak peek at the rule book
Oh,
of the financial game that we're all playing.
okay.
Knowing the rules can really help you make smarter moves, throughout the year.
Okay. I like that analogy. It's like leveling up our financial strategy.
Exactly.
So what's the first big change we should unpack?
Let's tackle the potential change to capital gains.
Ooh, capital gains.
Now remember, a capital gain is the profit you make when you sell an asset for more than you bought it for.
Right?
Currently, you only pay tax on 50% of that profit.
Okay.
But there's been talk of increasing that to 67% for gains over $250,000.
Hold on, 67%.
It's a big jump.
That's a pretty significant jump. Who would that actually affect, though?
Well, it's important to remember the $250,000 threshold.
Right.
If your capital gains are below that, you're not going to be impacted by this potential change.
Okay.
This is really targeted at higher value transactions.
Okay.
Like if you're selling a significant investment property or a large chunk of stocks.
So for the average person dabbling in stocks or maybe selling a few collectibles, this might not be a major concern.
Exactly. Plus, keep in mind the principal residence exemption remains untouched.
Okay.
So if you're selling your primary home, any profit from that sale is generally tax-free.
That's a relief. Okay, so maybe not everyone needs to panic about this capital gains change.
Right.
But what about something a little more universally appealing,
Okay.
like a tax break?
Ah, yes.
The Global News article mentioned a tax holiday extension. Tell me more about that.
The tax holiday, it's been extended to February 15th, 2025.
Okay, so
This means you can enjoy a few more weeks of savings on certain goods and services
I like it already.
because they're exempt from GST/HST.
Okay, spill the beans. What kind of savings are we talking about here?
Think restaurant meals, takeout snacks,
Ooh,
those tempting alcoholic beverages,
okay.
and even children's clothing.
Ice.
It's designed to provide a bit of relief, especially given the rising cost of living.
So, a few extra weeks of guilt-free indulgence, I can get behind that. But is this tax holiday really making a dent in those cost of living struggles? I mean, it's just a few items for a limited time.
Well, the Parliamentary Budget Officer estimates that this extension will save taxpayers around $1.5 billion.
Wow.
That's not an insignificant amount,
Yeah.
and while it might not solve the bigger issues, every bit helps,
I
right?
guess so. It's like a little bonus to start the year off on a slightly lighter financial note.
Exactly.
Speaking of helping out, the article also mentioned boosts to certain benefits. Can you shed some light on those?
Of course, programs like the Canada Child Benefit, or CCB, and Old Age Security, also known as OAS, are indexed to inflation. This means the amounts you receive are adjusted to keep pace with the rising cost of goods and services.
So these benefits aren't just stagnant amounts. They actually change based on how much things are costing. That makes sense, but how exactly does that work?
The OAS is adjusted quarterly based on the Consumer Price Index, or CPI.
Yeah.
So every 3 months, the payment amount could potentially change.
Okay.
The CCB, on the other hand, is recalculated annually in July.
So it's like a built-in safeguard to ensure these benefits don't lose their purchasing power over time?
Precisely. And it's important to note that these benefits are non-taxable, which is always a nice bonus.
All right, that's good to know. Now, before we move on to the next big change, I want to take a moment to really connect with you, the listener.
Right.
We've talked about capital gains, which might impact some of you,
Mm-hmm.
and a tax holiday, which probably benefits everyone to some degree.
For sure.
And then these benefit boosts, which are crucial for those who rely on them. Are you starting to see how understanding these seemingly small details can actually have a real impact on your personal finances? It's all connected.
It's about to get even more interesting
Oh.
as we delve into some changes that can impact your long-term financial goals.
That's a great tease. Okay, let's dive in what's next on our tax adventure.
Let's talk about saving for the future.
Okay.
The RRSP contribution limit, which is the maximum amount you can contribute to your registered retirement savings plan each year, is going up to $32,490 for 2025.
Okay, back up for a second. For those who might not be familiar with the RRSPs, can you give us a quick rundown?
Of course, an RSP is like a special savings account,
Okay.
specifically designed for retirement. The money you contribute can grow tax-free until you withdraw it in retirement.
Right.
And the best part is those contributions can be deducted from your taxable income which can lead to some sweet tax savings in the present.
So it's like a double win you're saving for your future and potentially reducing your current tax bill.
Yeah,
No wonder they're so popular. And the contribution limit increase means you can potentially sock away even more money this year.
exactly. And on that note, we're also seeing changes to other retirement-related figures. The YMPE, which stands for Years Maximum Pensionable Earnings, is increasing.
Okay.
This affects how much you can contribute to the Canada Pension Plan, or CPP. And speaking of CPP, both the contribution rates and maximums are also going up.
Okay, so lots of moving parts when it comes to retirement savings. It sounds like it's more important than ever to have a solid plan in place. But what about those TFSAs? Any updates on those tax-free savings accounts?
Unfortunately, no, the TFSA contribution room remains unchanged at $7,000 for 2025.
Well, that's a bummer, but hey, at least it's not going down, right?
True. Now let's shift gears a bit and talk about some changes that might be relevant to those running their own businesses.
Here's where it gets really interesting. I know a lot of our listeners are entrepreneurs,
Mm-hmm.
so this is definitely going to be useful. What's changing in the world of business taxes?
We're seeing some updates to vehicle deduction limits. For businesses leasing vehicles, specifically, the deductible limit for new leases entered into in 2025 is increasing to $1,100 per month before tax.
Okay.
And for vehicles purchased in 2025, the ceiling for capital cost allowances is going up to $38,000, also before tax.
Okay, so if I'm understanding this correctly, these changes mean businesses can potentially deduct a larger portion of their vehicle expenses.
Precisely. And there's also an increase in the per kilometer deduction for those using their personal vehicles for business purposes.
Ooh, tell me more about that. I'm sure a lot of people are curious about how that works.
For 2025, the deduction rate is 72 cents per kilometer for the first 5,000 kilometers driven, and then 66 cents for each additional kilometer.
Okay.
And for those working in the territories, the rates are 76 cents for the first 5,000 and then 70 cents for additional kilometers.
So whether you're leasing or using your own vehicle, those business miles can add up to some significant deductions. It's all about knowing the rules and maximizing those opportunities.
Absolutely. Now let's dive into a topic that might sound a little intimidating. Bare trust reporting.
Bare trusts, that sounds a bit complicated. Can you break that down for us?
A bare trust is a type of trust where the beneficiary has the right to both the income and the capital of the trust.
Okay.
It's often used for holding assets for minors or for estate planning purposes. Now, the good news is the CRA has extended an exemption on reporting for the 2024 tax year.
Okay.
So unless you're specifically requested to do, so you likely won't need to file any additional paperwork for your bare trust this time around.
Okay, so a bit of a reprieve for those dealing with bare trust, but I'm guessing there's still a deadline lurking somewhere, right?
You're right, for trusts with a December 31st, 2024 year end, that T3 return is still due on March 31st, 2025.
Got it. Mark those calendars, folks, now before we wrap up this part of our deep dive.
Yeah,
I
yeah.
know we need to talk about online filing updates, what's new in the digital world of taxes.
The CRA is constantly working to improve their online systems, and this year is no exception. They're introducing a new T619 electronic transmittal record, which is basically a cover sheet for information returns filed electronically.
So it's like a digital handshake, making sure everything is in order before you submit your return.
You could say that.
Okay.
They're also restricting online submissions to one return type at a time.
Okay.
This means you can't multitask and try to file multiple different types of returns simultaneously.
I guess that makes sense. It probably helps prevent errors and ensures everything is filed correctly. Any other updates we should be aware of?
Yes, they're implementing new online validations
Okay.
to help catch any potential errors or omissions in your return. Think of it as a safety net to help you avoid those dreaded notices from the CRA.
Okay, so it sounds like the CRA is really trying to make the online filing process as smooth and error-free as possible. But what about those who aren't so tech-savvy? Are there any options for them?
The CRA is continuing their automatic tax filing pilot program
Okay.
and expanding the Simple File by phone service to 2 million Canadians.
Wow.
These initiatives aim to make filing taxes more accessible and convenient for everyone.
That's impressive. It's great to see the CRA embracing technology to improve the tax filing experience, but what does all this mean for the average person trying to navigate this ever-changing tax landscape? What are the key takeaways we should be focusing on?
That's a great question,
Yeah.
and one we'll explore further in the next part of our deep dive.
Ooh, I like it. Stay tuned.
Stay tuned.
Welcome back. I hope you're feeling ready to jump back into the world of Canadian tax changes for 2025.
Yeah.
We covered a lot of ground in the first part of this deep dive.
Yeah, we did.
From potential changes to capital gains and those tempting tax holiday extensions,
Uh-huh.
to boosts for certain benefits,
Right.
and even updates to retirement savings plans. Whew, that was a lot.
It certainly was, and we've only just scratched the surface.
Right.
But before we dive into the next layer of changes, I'd be curious to know what stood out to you so far. What's piqued your interest?
Honestly, I think the potential capital gains changes are pretty big news.
Yeah.
I mean, increasing the inclusion rate from 50 to 67% for gains over $250,000 could have a significant impact on certain investors. It makes you wonder how people might adjust their investment strategies in response to this potential change.
That's a great point. It definitely highlights the importance of understanding the nuances of these tax changes
Yeah.
and how they might affect your individual financial goals. For some, it might be a non-issue,
Right.
but for others, especially those with substantial unrealized gains,
Mhm.
it could be a game changer.
It's almost like a ripple effect, isn't it?
Yeah.
One change can set off a whole chain of reactions and adjustments. And speaking of adjustments, I'm still thinking about that extended tax holiday. While it's great to save a few bucks on restaurant meals and snacks,
Mm-hmm.
I can't help but wonder if it's truly addressing the root causes of the rising cost of living,
Right.
or if it's just a temporary Band-Aid.
That's a valid concern. The tax holiday might offer some relief in the short term, but it doesn't tackle those underlying factors,
Right.
like inflation or wage stagnation. In fact, some argue that it might even contribute to further inflation by boosting demand.
That's an interesting perspective. It's
Yeah.
like trying to patch up a leak with a piece of tape. It might hold for a while,
Yeah.
but it's not a permanent solution. It makes me realize that we need to think beyond those surface level changes
Uh-huh.
and really dig into the long-term implications.
Exactly. And that's what we're here for, to peel back the layers and help you understand the bigger picture.
Okay, so we've talked about potential capital gains shifts,
Yes.
the tax holiday extension and benefit boosts. What else should we be considering?
Let's talk about those retirement savings plan updates. Remember, the RSP contribution limit is increasing to $32,490 for 2025.
Right.
This means you have more opportunity to take advantage of those tax-deferred savings.
And it's not just about RSPs, right? We also discussed the YMPE and CTP contribution rates and maximums increasing. It seems like there's a lot to keep track of when it comes to retirement planning.
Absolutely. But that's why it's so important to stay informed and work with a financial advisor if you need help navigating these changes. Your future self will thank you.
Wise words. Now, what about those business updates? I know a lot of our listeners are entrepreneurs and small business owners, so this next part is especially for you.
We touched on the changes to vehicle deduction limits for businesses leasing vehicles. Just to recap, the deductible limit for new leases entered into in 2025 is increasing to $1,100 per month before tax.
Okay.
And for vehicles purchased in 2025, the ceiling for capital cost allowances is going up to $38,000 also before tax.
So potentially some good news for businesses looking to upgrade their vehicles or simply make the most of those deductions.
And let's not forget the increase in the per kilometer deduction for those using their personal vehicles for business purposes. For 2025, it's 72 cents per kilometer for the first 5,000 kilometers driven, and then 66 cents for each additional kilometer.
Right.
And for those working in the territories, it's 76 cents for the first 5,000 and then 70 cents for additional kilometers.
Okay, that's a lot of numbers. But the key takeaway here is that those business miles can really add up. So make sure you're tracking them accurately and claiming those deductions.
Excellent point. Now remember that potentially confusing topic of bare trust reporting?
Uh,
The good news is that there's an exemption on reporting for the 2024 tax year. So unless the CRA specifically requests it, you likely won't need to file any additional paperwork.
That's a relief, but I'm guessing there's still a deadline we need to be aware of, right?
You're right. For trusts with a December 31st, 2024 year end, that T3 return is still due on March 31st, 2025.
Okay, got it. Now let's talk about those online filing updates. It seems like the CRA is really embracing technology to streamline the process.
They are indeed. They're introducing a new T619 electronic transmittal record,
Okay.
which acts like a cover sheet for electronically filed information returns.
Mm-hmm.
They're also restricting online submissions to one return type at a time, which helps prevent errors and ensures everything is filed correctly. And to further enhance accuracy, they're implementing new online validations to catch potential errors or omissions.
It's almost like having a virtual tax assistant looking over your shoulder and pointing out any mistakes.
Exactly. And for those who might not be as comfortable with online filing, the CRA is continuing their automatic tax filing pilot program and expanding the simple file by phone service to 2 million Canadians.
It's amazing how technology is transforming the way we handle our taxes. But with all these changes, it can be easy to get lost in the details. So, what's the big takeaway for our listeners? How can we connect all these dots and make sense of it all?
That's a great question and one that we'll explore further in the final part of our deep dive. Stay tuned.
Welcome back to our deep dive into the 2025 Canadian tax changes.
Yeah,
We've covered a lot of ground,
they have.
from potential capital gains shifts and tax holidays to those benefit boosts and even those online filing updates.
Yeah, it's been quite a journey.
It has been. So let's zoom out for a moment and think about what all this means for you, the listener. Imagine this is your financial landscape. These tax changes are like shifts in the terrain. Maybe a new path opens up here, a little detour there.
I like that visual.
Yeah.
And just like navigating any landscape, the more you know about the terrain, the better equipped you are to make informed decisions and choose the best path for your journey.
Okay, so we've got our map and compass ready to navigate this financial terrain. What are the key landmarks we should be looking for?
First, consider those potential capital gains changes. While they might not impact everyone, if you're an investor with significant assets, this is something to watch closely. It might be time to revisit your investment strategy and consider any adjustments you need to make.
Right. And even if you're not directly affected by the capital gains changes, they're a good reminder that the tax landscape is constantly evolving. It pays to stay informed and be proactive about your finances.
Absolutely. Now, while that extended tax holiday might seem like a small blip on the radar,
Yeah.
it actually raises some interesting questions about the government's approach to tackling the rising cost of living. Is it a sustainable solution or just a temporary fix?
It's like that old saying, give a man a fish and you feed him for a day, teach a man to fish and you feed him for a lifetime perhaps. Instead of focusing on these short-term tax breaks, we should be looking at more long-term solutions to address the root causes of these economic challenges.
That's a really insightful point. It's all about finding that balance between providing immediate relief and investing in those long-term solutions that empower people to thrive financially.
Okay, so we've got our potential capital gains changes and the tax holiday prompting us to think about the bigger economic picture. What else should we be keeping in mind as we navigate this financial landscape?
Those benefit boosts are a good reminder that there are systems in place to help those who need it most. The fact that programs like the OAS and CCB are indexed to inflation ensures that they retain their purchasing power and continue to provide vital support.
It's almost like a safety net woven into the fabric of our tax system. And speaking of that system, we can't forget about those updates to online filing, from new electronic records and validations to the expansion of automatic filing and phone-based services. It's clear that technology is playing an increasingly important role in how we manage our taxes.
It's an exciting time to be navigating this evolving landscape. Technology has the potential to simplify processes, reduce errors, and make tax filing more accessible and convenient for everyone. But it also raises questions about the future role of tax professionals.
Yes, that thought-provoking question you posed earlier. Will accountants and tax preparers become obsolete, or will their expertise simply evolve?
I believe there will always be a need for human expertise when it comes to navigating the complexities of the tax system. Technology can certainly streamline processes and handle routine tasks. But when it comes to strategic tax planning, understanding nuanced regulations, and providing personalized financial advice, a human touch remains invaluable.
I agree. It's about finding that synergy between technology and human intelligence. Perhaps we'll see a shift towards tax professionals taking on more of a consulting role, guiding individuals and businesses through the ever-changing tax landscape and helping them make informed decisions that align with their goals.
I think that's a very likely scenario.
Yeah.
It's not about replacing humans with machines. It's about leveraging technology to enhance our capabilities and create a more efficient and effective system.
Well said. So as we wrap up this deep dive, what's the final message we want to leave our listeners with?
I'd say this knowledge is power, especially when it comes to your finances. By staying informed about these tax changes and understanding how they fit into the bigger picture of your financial well-being, you can make choices that empower you to thrive.
Beautifully put. It's not just about crunching numbers and filing forms. It's about taking control of your financial future and making informed decisions that align with your goals and values.
And remember, you don't have to navigate this journey alone. There are resources available to help you every step of the way, from financial advisors to online tools and even this very podcast. There's a wealth of information out there to support you.
Absolutely. We hope this deep dive has provided you with valuable insights and perhaps even a few aha moments along the way. We encourage you to continue exploring these topics and to stay curious about the ever-evolving world of personal finance.
And if you're eager to delve deeper into any of the topics we've discussed, be sure to check out the show notes for links to additional resources we've got you covered.
A huge thank you to you, our amazing listeners, for joining us on this journey through the Canadian tax landscape. We're so glad you could be here. Stay tuned for more insightful episodes coming soon. Until next time, happy navigating.